We are going to get started. Thanks everybody for joining. I am Andy Marks. I am the Senior Vice President of New Business and Marketing at Maxwell-Kates. Welcome to our first quarterly webinar of 2023. This webinar is going to be an exciting one because we're talking about property taxes. Very exciting. But we're going to do these quarterly as we did in previous years. And today, again, talking about property taxes for co-ops and condos. With me tonight are my fellow panelists, Maxwell-Kates CEO Max Freedman, and Robert Maina, who is our CFO, and then property tax consultants with whom we partner on behalf of many of our management clients of our managed properties, Stan Russo, who's a longtime expert in property taxes. So it's a Zoom webinar format. So we have everybody, the only people that you can see are the four of us. Everybody who's viewing has the ability using your Q&A or the chat to ask your questions. Hopefully you've come prepared with questions. But in case you didn't, I want to get started right away by asking to do a bit of a level set. Because I think we all think people confuse two things. One, the tax certiorari, which is the annual protest of property tax valuations, and the other is abatements. And so we're actually going to talk about both tonight. So getting started with a question, just again to level set, so we're using the same terminology. What's the difference between the tax protest process, the certiorari process, and tax abatements? People often, again, confuse the two, but they're distinct from one another. So what's the difference? Stan and Max, maybe you can opine on that.
Sure. Stan, do you want to take the tax certiorari and then I can hit on the exemptions and the abatements?
Sure. So starting with tax certiorari, and just to hit the point, terminology is critical. I understand it may sound like it's just semantics, but understanding the correct terminology is a key to not getting things incorrect or understand what kind of question you're asking. Tax certiorari is the process of challenging the city's imposed valuation on your building. It's a Latin term, and it means it's essentially a lawsuit whereby your tax certiorari attorney is going to sue the city on your behalf over their assessed valuation. You would get a new assessed valuation each year, and then the attorney would challenge that by filing a lawsuit. That's what just happened in January and February, and it happens every year. I'll turn to Max.
Thank you, Stan, and thank you, Andy, and thank you everyone for joining tonight. The city of New York also offers tax breaks known as exemptions or credits to seniors, veterans, people with disabilities, and others. And these exemptions, it's a type of tax break that reduces your assessed value before the taxes have been calculated. If you're granted an exemption, it's subtracted from the assessed value of your home, reducing your taxable value. On behalf, as it relates to the abatements, the management company, we Maxwell-Kates, are tasked with filing the abatements for all eligible shareholders and owners prior to February 15th of every year for the subsequent tax year. So for the 2023-24 tax year, which starts in July of this year, we filed the abatements for the owners and shareholders of our developments that had either new transactions or sales that occurred between January 5th of 2022 and January 4th of 2023, and also residents that moved into their apartments that potentially they were either renting out or they were not primary, or that they were not primary prior to that period. So that is in essence is the difference between abatements, exemptions, credits. There are a number of them, as I mentioned before: STAR, Enhanced STAR, SCREE, Veterans, Disability, and the difference between those and the tax certiorari process, which Stan referenced earlier.
If I can just add one thing, very important. Max brought up January 5th. January 5th is a key date in New York City because it's what they deem the taxable status date. The status of your unit or building on that date is how they record any changes. So if you were to move back into your apartment and think you get the primary residence on January 6th, you have to wait the entire year. So right. January 5th is a very important date.
Great, that's great information. By the way, those who are viewing, hopefully again you came with questions, and as questions come up in your mind while we're talking or our panelists are talking, please do use the chat and or the Q&A to ask your questions. We'd love this to be interactive. So just moving on, Stan, from a tax certiorari perspective, can you go a little bit into how does the city actually compute the value upon which the taxes are based? I understand it's based on rental value. Can you elaborate on that?
So using co-ops and condominiums as the primary example, the city imputes value based on as if those properties were rental buildings. Since they're not rental buildings, what they do is the assessors select 3 random rental buildings at least in the area that they will deem comparable. Those comparable rental buildings, they use their gross income per square foot and attach that to the subject building. So if they're using $40 a square foot in income, they take that $40 a square foot, attach it to the square footage of the co-op or condo, and come up with a fabricated, estimated income in order to start their valuation. So everything is really based on rental values. Very important to understand, if you're a co-op or a condo with a lot of unsold units, those are not the rents that they're using. They're using rental buildings aside from your building that are fully rented. They're not co-ops or condos. They don't compare co-ops to other co-ops. That's just an exercise for people to find out where they stand, but it's not an arguable challenge. So in New York City, property tax system is based on rental value.
And if I could just add to that, Stan and Andy, also to bear in mind, cooperatives and condominiums do not exist for New York City real estate tax purposes. As Stan mentioned, they're valued as if it were a rental building operated by a profit maximizing landlord. So the operations of a cooperative and a condominium, for the most part, including its sales history, are somewhat immaterial for the real estate tax purposes.
Yeah, and very good point. To add to that, I get a lot of questions. Why is, my maintenance is this? Why do they say my rental value of my apartment is this? Well, maintenance is what we call a ghost figure. It's what your portion of operating the building you live in is. If I were to drop a sack of $5 million on your doorstep and your maintenance went to 0, it wouldn't mean your value crashed. So it's really more about what the building can rent for if it was full up rental and how that pertains to the rentals in the area.
Got it. All right. Helpful. Now, so in relation to tax or the abatement process, somebody does have a question. Let me So this is from Jeffrey Tyndall. Thank you, Jeffrey. I vaguely recall an initiative by the city to revisit this whole area of valuation. Where does that stand?
I'll field that one. I think that every co-op and condominium unit owner can be very happy that that's gone nowhere. There was a huge push a couple of years ago to have the entire process revalued, because the thought was people who live in their own homes in New York City, you'll find that a lot more in the outer boroughs than in Manhattan, they get a special advantage. But the advantage that co-ops and condos get are that primary residency abatement to sort of mimic the advantages that homeowners get. Revamping that property tax system for co-ops and condos and how they value them would be catastrophic. If they were to move to a sales model, and I explain this to all people who say this, who ask the question, it would at least triple your taxes. Rental values are the best way to argue valuation for a building. It's just a matter of the valuation process, and the comparable process is so vague and opinionated. That's where you have this room for tax certiorari to argue alternate opinions.
And to the benefit of co-op and condo.
Correct.
Right.
Correct. So I guess more to answer that question, it hasn't gone anywhere. About 13 years ago, they said they were going to revamp the system, and they still haven't done it. So this is the second time they're going to revamp the system. And I believe that up in Albany, they realized that's not going to happen.
Great. Thank you. So I was referring this to Rob or Stan in terms of a building's budget process. How do these two disciplines relate to the budget process? Because all of our clients, our managed clients, are dealing with budgets. Many of them have already completed their budgets for the calendar year, and so how do the two things relate?
So I'll touch upon both abatements and the assessed values. So when we begin our budget process, usually September, October, this is before the final assessments come out after the new year. So what we do in the budget process is we take the assessed value from the prior year and we put a percentage increase to that assessed value. Now, the calculation to get a transitional value, it's a 5-year phase-in. So we take the 4 prior years that we know are, final numbers, and then we have basically an estimate for the following year. That number goes into the budget. We do the calculation for the taxes. And what we do is come January, when the final assessed values are released, we'll go back and we'll take a look at those assessed values, final compared to what we had in the budgets. And then if there's a significant difference, we'll discuss with the boards on how we're going to, cover if it's a large deficit, or, we'll discuss with the boards on how to proceed. On the abatement end, so on condominiums, the abatements get put directly on the owner's tax bills. On the co-ops, it's a reduction of the real estate taxes for the co-ops. So then come November, December, we get tax benefit letters from the Department of Finance, and we have to then, by June of the following year, have to give those credits back to all the eligible shareholders. And what we normally do is we'll do a credit on their maintenance bill, and that's covering, like Max said, you have Star, Veterans, and the co-op abatement. 99% of buildings will do a special assessment tax to recoup those credits that we have to issue on the maintenance bills. What we've seen is some buildings starting to, break up a portion of that assessment and use part of it for operating and part of it for a reserve fund. So those are the two different aspects that go into the budget process.
We have, that's great. We have a couple of other questions here. This is from Lisa. Is TJ tax the rentable property or the gross square foot of the building? I'm not 100% sure what. All right, we'll go on from there. There's another one, Judith Febraro. There is also the SCHE for co-ops. Is MKI in the STAR, or individuals have to apply on their own? We know the 421A expired. Some of us were at Senator Serrano's office today.
I can answer that. So the senior citizens homeowner exemption is one of the exemptions that I referred to earlier. Like STAR, where the individual shareholder or the owner are responsible for applying for that directly. The 421A, if you have a 421A on your building, yes, it's important to know when that expires, because when that does expire, the managing agent, what we do is we submit an initial either co-op or condo application to the Department of Finance that lists all of the owners, their names, their social security numbers, their sales date, the number of rooms in an apartment, and it's an in-depth process that we submit to the Department of Finance in order for that development to become eligible for the co-op condo abatement. And just one other quick thing to note with the abatements, there was a change that was passed into law in 2021 when Governor Kathy Hochul signed an amendment to the real property tax law, requiring properties to pay prevailing wage to their staff, or they would no longer, or that development would no longer be eligible for the real estate co-op condo abatement. And there were certain properties that were exempt from that prevailing wage obligation. It's based on the assessed value of the development and the number of units. So Maxwell-Kates did lengthy analyses for those properties that needed to pay prevailing wage that weren't, and discuss those with the boards to decide whether or not it made financial sense to pay staff prevailing wage in order for those shareholders or owners to keep the abatements.
If I could touch on two things regarding 421As, despite the fact that you get a 421A and you're not paying a large amount of taxes, you're paying just base tax, it's still important to file tax certiorari protests. One of the most important reasons why you should be filing that is there are a lot of unit owners who will buy into 421As and sell when the tax hits. It is harder to sell that unit if the taxes have never been challenged and there is this giant overstatement of valuations, a lot of which will affect when the 421A expires. So it is important to file your tax certiorari with a tax certiorari attorney. It's not about the 421A, it's about the valuation and trying to get that correctly lowered.
Right.
Secondly, regarding the prevailing wage, it's important to understand that if you were getting your abatement the prior year and now this year you're not, comparing last year's taxes to this year's taxes is a falsehood. There's a missing problem there. You're comparing essentially a net to a gross. So if you see that your taxes went up 33% and don't understand why, it's the comparison of an abatement lowered tax to a non-abatement gross tax. So those things have to be taken into account.
And I think, Andy, with the question from Lisa, I think it was asking whether or not the tax is based off of the gross square footage of the building. And,
Yes.
and I think that Stan, if you could answer that.
I can answer that. So square footage is one of the two primary components towards valuation. The other is rental comparables and that gross income. Whatever buildings they decide to use and whatever number they come up with gross income, they're going to compare that to the gross square footage of the entire building. It's important to make sure that your gross square footage is accurate. I've already spearheaded over 100 challenges to the city to get these gross square footages corrected because they have them overstated. Now, not every building square footage is overstated. We've measured, I know an architect who does a lot of measurement work for Maxwell-Kates buildings and a lot of other buildings. Not every report comes back where there is an error. But when there is an error, it's important to let the city know because you can get back taxes returned to you and refunded, and you can change your square footage going forward forever, which will artificially lower your taxes forever.
Would you say, Stan, that it's a good investment on the part of a building to if you're unsure to hire an architect that does this kind of thing to make sure that your square footage is correctly stated?
I think good is an understatement. I think it's not required, but I think it's imperative.
It would seem that way.
Yeah.
And would you say the majority of buildings that go through that process, it's usually, not all the time, as you said, but a lot of the time there's incorrect square footage that the city has?
From my experience, we've been doing this for the last, I want to say 7-8 years, since 2016, when Mayor de Blasio announced that he would allow the city to correct clerical errors and go back 6 years. We spearheaded an outreach to try and get as many buildings measured as possible. We've gotten over 100 that had errors and brought them to the Department of Finance's to their desk. We've probably measured over 175, so it's more than 50% have errors. Now, we may get the next 32 without an error. It's a building by building issue, but for the investment, it's definitely worth it, just to know. And that report that an architect, whichever architect you use, that architect provides, that can be used for so many other items anyway.
Sure. Okay, a couple of other questions coming in. So from Doug Rice, how do non-performing or vacant retail units impact the co-op assessed value calculation? And is there any way to utilize the loss or vacancy in a proceeding?
It's a very good question. I'll take that. It's a very good question. So the process is that space has value. Vacant space still has value. It's a matter of explaining to your tax certiorari attorney that the space that you have is vacant, and really it's more about commercial space. Residential space is very rarely vacant in a co-op. It's more about the commercial space. By telling your tax certiorari attorney that your commercial space is vacant and giving him that information, he can use what I refer to as a bolstering argument. And the argument that that certiorari attorney would present is rental comparables to try and lower the assessment, and then hit them with a secondary argument saying, and in this building, the commercial space has been vacant, so there's some tax relief that should be imposed there. And so the combination of those two factors should be designed to weigh that hearing officer to make an offer. The problem is that so many people think that or believe that vacant space has zero value, and the city is not willing to go to that level yet. It's just a matter of getting your certiorari attorney as much information as possible and allowing them to use their arguments as best as they can.
You're telling a story.
Correct.
In essence.
Valuations are opinions, and their job is to sway the person on the other side of the table that their opinion is better than the Department of Finance's assessor's opinion. And during the year, approximately 19% of all filings that get hearings get reductions that are accepted offers. So over 60,000 applications are filed, over 50,000 hearings take place, and there's usually around 12,000 offers, 11,000, 12,000 offers. So 90%, 19% might not seem like a lot, but that changes year to year to year with which buildings fall into that 19%. You want to arm your vendors with as much positive information as possible.
Sure. More questions. Jeffrey Tyndall, Stan, are building assessments challenged every year for every MKI building? And how successful are you typically?
So I'm not a tax certiorari attorney. I don't argue with the city. Your tax certiorari attorney, depending on your specific building, you have to look at their history and how they're doing. If I'm working for you as a consultant, I would want to have a conversation with them if they hadn't gotten results in a number of years, find out why. Not every co-op is deserving of a reduction. I consult for a law firm, and we handle a building called the Normandy. And this is a gigantic building that is so underassessed, we still file every year because you can always make an argument, but you're most likely not going to get a result. It's really about how comfortable you feel with the certiorari attorney's success over a course of years. You never want to jump from attorney to attorney to attorney. You want someone that handles things in a detailed fashion, has the building's best interest, and is ultra aggressive. So if you wanted to privately present a building and I can look into that, I'm more than happy to help.
And just to answer the first part of that question, the answer is yes. Every year, buildings managed by Maxwell-Kates, we ensure that whoever is their tax certiorari attorney does receive the paperwork in time to challenge those assessed values.
Yeah, sorry about that. I skipped over that part. That's a rote process. If there are potential clients here who are with other management companies and they fail to get those in, you really need to make sure that your master vendor is taking care of those mini vendors.
Right.
What are the implications on that point? What are the implications for not filing on time?
That's a loaded question. I'll say this. In my dealings, I've had management companies reach out to me and ask me what their liability is for missing filing. And it is not good. And they've had to have conversations with their client and settle. And that's under my advice. You never want a client to sue you over missing something like this. The goal is to have a management company that is on top of everything, make sure that they have quality people looking over it, and 100% is a pretty good number. So that's where MKI was.
Right. More questions coming in. Okay, Nancy McKeon. Board members change over time, which is why professional management is so important. Will MKI have records for our building to see if this remeasuring, back to the remeasuring, has ever been done? And bottom line, what might such measuring cost?
I could answer the second part of that question for Nancy. Last year, we had this remeasuring process performed at a 300-unit condominium in Midtown. The cost of that was just over, I believe it was $6,500. And we're talking about, if memory serves me correctly, in excess of 315,000 square feet. With respect to, it's a great question, with respect to records to see if this measuring has ever been done, I believe if you retain an architectural firm to do this, and it's submitted to the Department of Finance, it should be public record. Correct me if I'm wrong, Stan.
I think that everything submitted to the Department of Finance is public record and can be foiled under Freedom of Information Law Act. If you have an architectural firm, they're going to have the paperwork and they're going to know whether or not they've done it. If you don't have one, and I mean don't have one in the last 10 to 12 years, it might be good to get a new measurement. And to speak about what Max said, I remember that building. The difference between buildings and how they are formed is very important to pricing. I've seen gigantic unit buildings that are boxes that are much less. But when you start getting into crazy cutouts, because gross square footage is defined as outside diagonal to outside diagonal, the more cutouts you have, the more oblong shapes, the more difficult it is for the architect that I recommend. And why I recommend that person is his reports have been wholly accepted by the Department of Finance in these challenges. But again, I'm more than willing, if someone were to give me an address, to get a quote.
Okay, great. And so that's that. John DeCola asked, should the city become aggressive and overshoot reasonable assessments in any given year, which then is successfully challenged and reduced, a building could be faced with a material legal bill that could not be anticipated in the budgeting process in Q4. How do you advise buildings to budget for these potential swings in the event the city pivots and looks to greatly increase assessments in any given year?
So if I can, I think Rob should answer that first part, but I want to step in after.
So as far as the legal bill, what we do is, and probably Stan, I'm going to say what you'll follow up on. When a year is settled, when the offer is made and it's settled and we receive a refund, we get a schedule from the tax cert attorney that would go to Stan to review. When our office gets that back, that schedule has each apartment listed on there. It has the refund allocated to that apartment, but it also has the legal fee related to that apartment. So on a financial impact, although we're going to be paying the tax cert attorney the legal fee, that legal fee then will get billed back to the shareholders to recoup that money. So it's on a cash flow, it's a zero impact because that bill will be paid, but we'll recoup that money. Now the timing might be off on when that money's recouped, but we will recoup that money billed back to each shareholder.
So to touch on that, you would be surprised how many management companies don't get this accurate, but that is a perfect analysis of how, for a condominium, this process should take place. It should be $1 in, $1 out, $1 out, $1 in. So in this instance, the condominium is acting as the unit owner's agents. And all they're doing is paying a bill and recouping that money and getting a refund check into their operating account and then dispersing that to all the unit owners. For cooperatives, it's a little different. I'm not a budget expert. In my opinion, and I'll leave it to Rob to say whether it's feasible or not, when you budget for taxes, you create an account that is strictly for taxes that is escrowed. And when your taxes are reduced, you have a surplus in that account. That surplus can pay the legal bill. So it's not like you'll be forced in Q4 with a gigantic legal bill. You'll be given a legal bill that can be easily offset by the surplus in your tax account because your taxes are less now. That's just the way I look at it. A lot of people don't look at it that way. I always say you should want to pay your tax cert attorney as much as possible, because for every $1 you pay them, you're paying the city $8.
Right. Stan, thanks for that distinction. On the co-ops, correct. So we would either escrow real estate taxes with the mortgage company, or what we do internally is if the mortgage company doesn't set up an escrow, we set up an escrow. So as Stan mentioned, a reduction in the taxes, a less expense paid to the city, there would be excess funds either internally in our escrow account or the escrow account that's held by the bank.
Great. Okay, that is John. Okay, Judith Febraro. Can seniors apply for SCHE while still under 421A? Today, we were told that Albany was trying to revise the SCHE program to allow that. Not sure yet. The concern is seniors getting hit with high real estate tax on fixed incomes.
Right, so the senior citizens homeowner exemption is available to owners of co-ops and condos who are 65 years or older with an annual income, I believe, of less than 58,000 per annum, and which reduces your assessed value up to, I believe, 50%. My understanding is that if you are currently on a 421A, you are not eligible for the senior citizen exemption. But these rules, as Judith has mentioned, are changing very quickly. So we're also waiting to hear what the Department of Finance in New York City and New York State are planning to do about that.
If I can jump in too, I wanted to thank Judith for 1 second. That was at first the question that I've never been stumped before by any question. And I thought that was going to be it, but Max is right. When you have one exemption, you can't have another exemption. So while under a 421A, you cannot get a sheet.
Right.
Okay. Doug Rice is asking, is it possible to argue that the peer rental buildings the city has determined are not accurate peers? I recall at one point long ago seeing the buildings they were using, and while we are in Kips Bay, they had us peering with a West Village luxury rental building, which seemed a little unusual, and a neighborhood which we believe has much higher rental values than our co-op would yield in the free market.
So I'll jump in on that. That's the foundation of tax certiorari. The foundation is the city chooses rental buildings, and the certiorari attorney chooses alternate rental buildings with lower income to make an argument that your subject building should be comped to those alternate rental buildings. I'll go one step further. If the question really is there an argument that they don't have the right to choose those buildings? The answer to that's no. They're unfortunately within their purview to select any building they want to use as a comparable. And I've seen some crazy buildings. A Central Park West co-op being compared to a Park Avenue rental. It is insane. And of course, that building got a reduction at the tax commission by using alternate rentals, but it was impossible to tell the city that they had no right to do that.
Okay. Any other questions? I'll ask one. When an offer is made by the city to reduce the tax valuation and is presented to a board, and assuming they decide to accept the offer, A, when would that occur? And B, what are the internal processes for how that then gets implemented and reflected in the finances? We kind of went over that a little bit. But in terms of the timing, when do those offers from the city essentially come in? And then, what are the processes for, processing those reductions if you achieve a reduction?
Sure. So just to clarify the terminology, the city is too broad of a term. There are essentially multiple organizations within the city. We're going to clarify it into 3 separate organizations. The Department of Finance is one. They don't offer anything. They impose. They impose the original assessment. If there's a clerical error, they impose a reduction. You don't have the right to reject it. They're just giving it to you. The tax commission is the jurisdictional body that hears all these arguments for the current year and the prior year. They only have the jurisdiction to reduce the current assessed value and the prior assessed value. They have hearings throughout the summer. So starting May through essentially November, sometimes late, sometimes in December, but mostly through November. It's a crapshoot on when your building is going to be paired with other buildings in that same area for your attorney as to when you're going to get heard. Sometimes you get heard in May, sometimes you get heard in November. It's really just where the luck falls. The department, the New York City Law Department is the third group. If you have enough years open and there is merit to those older years, your tax cert attorney will go to the New York City Law Department. Those are called conferences rather than hearings, and they're heard by attorneys, generally. There are some assessors there and some other people who hear those cases, but generally the attorneys. They're the attorneys for the city. They can make offers on older years at any time during the year. That is a much slower and more arduous process. But if you're looking for an easy answer, the tax commission hears cases from May to December, May to November, and they make offers, if you're going to get an offer, approximately between 2 to 6 weeks after the hearing. Very important, if the hearing officer has done their job. And if there are any tax certiorari attorney people here listening to this, they know exactly who I mean. There are about 20 hearing officers at the tax commission, and some of them just hear the cases and then don't do anything. And then the president and the higher staff have to do their job. So those cases sometimes take a little longer. The most important thing to understand is, while the taxes are being imposed upon you and you feel that they are overstated, there has to be a patience with this process.
So the idea then is up front, you're kind of laying out, here's the process, here's the timeline, and be patient. In other words, it doesn't help the process to constantly be asking what's the status, because it just takes time.
Now you may get lucky. You may get condos. Some condos are heard in May. And if a condo is heard in early May and the hearing officer does a good job and makes an offer, that settlement can be processed prior to the July bill. And then your bills will be lowered than what they would have been without that reduction. But again, I would say 10 to 15% of cases, maybe 20% of cases are heard in a quick enough time where offers can be accepted and processed prior to the July 1st due bills.
Gotcha. Okay. Any other questions coming from our participants, the audience? We had some good ones so far. Anybody else? And gentlemen, thank you. Please feel free to offer up any final words of wisdom on this subject, which is fraught and with all kinds of frustration and celebration, both ends of the spectrum. Any words of wisdom to offer?
I think the most important takeaway from this is for our managers, our staff here at Maxwell-Kates, to be as communicative as possible to our boards and the shareholders and owners in those respective developments. This is a complicated process. We have a lot of knowledgeable, skilled folks with the expertise that can help assist, and it's our job in this call it reactive environment that we're in, to be as proactive as possible on this very, very important topic, where for at least in the co-op world, real estate taxes represent at this point in time, on average, somewhere between 55 to 65% of your maintenance. So it's a really important area for us to focus on. Even if we don't have the answer, we need to be able to explain the process, communicate, so that our boards are aware, can make these decisions, and can act in the best interest on behalf of their fiduciaries.
And just to add to that, I'm always available to answer questions. If I don't know the answer, I will respond and tell you that I don't know it, and I'll go find it out. But I think that, as Max said, clear line of communication is critical. When you ask a question, you deserve at least an acknowledgement of that question, and at some point in the near future, an answer. So anyone who's ever asked me a question and I don't know the answer, I'm at least telling you that. But that's a very critical part of this process.
And Rob, any other words to share?
I think it's just important to really, especially during budget time, to look at the taxes, look at the abatements, look at the special assessment bill backs. You know, we keep in our budget format, we have many years of history going back. And I think that just shows the history of the assessed values. When we, just to touch real quick, when there are settlements and the assessed values are reduced, we do go back into our schedules and we make those changes. So historically, we'll see those numbers because they do impact the future taxes.
Great. And I would just echo from my own perspective, having been on both sides of this divide as a former board president of a co-op on the Upper East Side, and now on the service provider side, what both Max and Stan said, communication is key. And that, unfortunately, in our business is a significant pain point for many boards, is that they can't, for some reason, ghosting exists in our world. And that shouldn't be the case. You should, to Stan's point, be acknowledged for the question that you're asking. And if an individual, especially a manager or somebody at a management company, doesn't know the answer, they should let you know that, and they should get back to you timely with an answer. I'll put on my marketing hat again and say that we at Maxwell-Kates pay a lot of attention to those attributes: proactivity, communication. So with that, we have about 10 minutes left, and we're going to give that back to all of you listening in. I think we covered a lot of ground here and answered a lot of questions. Just so you know, this will be recorded, or it is being recorded. Oh, Judith came back with another question. Okay. Judith Ferraro. In July, we will get hit with a percentage of real estate tax. Since tax changes per year, do we know what the 20% will be?
I think I understand the question, and I have to say that there's a flaw in the question, and just hear me out. Your taxes are based on 5 years worth of values, so that this valuation currently is responsible for 20% of your taxes this year, but your valuation is static. So the taxes that you pay are an amalgam, a transitional average of 5 years worth. The value for your building was released already on January 18th. That's public record. So When your bills come out in June, they will reflect that number plus the prior 4 numbers, the assessed valuations, added together and divided by 5. So that technically the 20% you're referring to, I believe, whenever you get a new assessment every year, that is responsible for 20% of your taxes from an average perspective.
Great. Thank you. One more question from John DeCola. Do you expect the city to push for aggressive increases in assessment over the next few years?
No. As I understand it, the city's job is to pay for services. They have a number that they have to meet. And in order to meet that, they have to spread that tax burden out through the millions of buildings throughout New York City. I don't feel that they're actively, aggressively going after buildings to meet that. All they would have to do is change the tax rate, which the city council does every September, October, November, to make up a budgetary shortfall. I don't think that assessed valuations are going to skyrocket over the next couple of years. However, that changes with rents. If rents continue to rise, then assessments will rise, especially for co-ops. And it's important to understand assessments are based on, values are based on rentals, but in any rental building, you have 3 types of units. You have controlled and stabilized units, which are low rents, and then fair market, which are the higher rents. When you have units that are controlled or stabilized becoming fair market, you have a giant pop in gross income. This is what happened in the 2010s. From 2010 to 2019 for co-ops, assessments rose on average about 13% because a lot of rental building owners were buying out those controlled and stabilized tenants, and their gross income skyrocketed each year because they would take $200 rents and turn them into $5,000 rents. That has stopped now. There was 2019 legislation that made it harder to do that. So there should have been a leveling off process. But to speak to that, you're being valued based on a grouping of 3 different types of rents, not fair market. If at some point the entire city becomes fair market, then it will just be a completely flat leveling process. Until that point, you'll have increases each year.
Great. All right. Any other final questions? Oh, we do. I love it. Judith, presently we are still under 421A until the next 4 years. Concern again for seniors under $58,000. Also correct me, one cannot apply for STAR and SHE.
That is correct. When you benefit from one exemption, such as the 421A, you are unable to receive additional exemptions. In this case, the STAR, which would act as a credit. You may want to, Judith, if you'd like, we can take this offline tomorrow, because in 2016, the city changed its rulings on STAR eligibility. Previously, most applicants were receiving STAR through the exemption, which was you would get the credit through your maintenance when we return the abatements and the STAR every year in June, as Robert said. Now, shareholders and owners are no longer allowed to submit an application for the exemption. You can only submit an application for the credit, which is where the city Department of Finance sends you a check directly. So this is something that maybe we could look into. I don't believe you would be eligible for it. You certainly would not be eligible for the SHE, but it's possible that you may be eligible for a STAR, assuming it's your primary residence.
Okay. So with that, I want to thank my panelists, Max, Stan, Rob. Thank you so much for your time.
Thank you.
And imparting your knowledge.
Thank you.
Everybody, we have, as I mentioned before, we have recorded this. For those who are on boards and want to share this with your fellow board members, we will make this available to all those who participated, the recording, and then you can share it out. Thank you again, and have a great night.
Thank you.
Thank you. Good night.
Good
Yeah.
night.